have with me now Vanessa Hofmeyer from Citadel. Thanks very much for your time. Well, we're discussing emerging markets, developed markets in this environment, and funny enough, I was speaking to Koki Koiman earlier today from Sanlam Investment Global and Gavin Joubert from Coronation, and we got to this discussion on emerging markets and developed markets that actually these two are moving very closely together. So it's difficult to differentiate, almost. Is that a fair comment?
That definitely is a fair comment. You can take it through from the ratings. The ratings are converging, where previously you had very, very high discounts between emerging markets and developed markets. You then also had very high premiums between the two, but generally those, in terms of pricing, are converging, but also the companies. So you'd have a company that's listed in a developed market, which technically is an emerging market play because the bulk of its underlying sources of revenue are reliant on emerging markets, and a little bit of vice versa, where you can have an emerging market listed company that relies very heavily on developed markets. So in general, a lot of the global economics and the globalization is bringing the story closer, but I think you can still come to a conclusion of how you rate a developed market versus an equity market stock very, very differently, because ultimately emerging markets do behave differently if you look at the economies to a developed market play.
Is South Africa definitively an emerging market?
You
knew that question was coming.
I knew it was coming. There's certain pockets where we are very definitely developed market. Our financial sector, in my opinion, is very much very advanced, and I think developed market, but definitely there are other pockets where we are most definitely an emerging market. So if I had to say, we'd probably a little bit of both, which is probably not the strong answer, but probably the correct one.
The other theme that has emanated from many discussions recently is that South Africa is now starting to look expensive, and that's give or take the last couple of days. Let's just put aside the volatility that we're seeing at the moment. Is it difficult to find value in the South African market at the moment?
Yes, it is, but first of all, if you look at within equities, developed markets are very attractively priced, and so are emerging markets. So whilst equities look attractive within that space, that's why South Africa is not as compelling anymore. Our price earnings ratio is around 12.5 odd. It's not expensive, but the alternatives out there in the equity space is that much cheaper, more attractive, absolutely. So then when you come back within the South African market, what do you do when on a relative basis it's not that attractively priced? And one of the things we've done in our portfolios is buy dividend-focused stocks. And it's actually been a fantastic strategy for individuals because you get a decent yield in a very low yield environment. And the kinds of companies you're buying have healthy balance sheets, lots of cash flow, and they aren't expensive because they generally haven't necessarily been hot, sexy stocks. It's mobile companies, some of the resource stocks that aren't necessarily overpriced. So it has actually worked, but it is in an environment where interest rates are very low. And so that does support the strategy.
And of course, now we've also got that debate raging as to when we're going to see the first hike on the local front. It looks as though most economists are throwing forward to mid-2013 because ultimately interest rates in South Africa do have to normalize. It is going to happen at some time, but the other side of the argument is that the South African Reserve Bank is also focusing on growth, and with all the uncertainty, they can't afford to hike interest rates in the short term. I'm not the expert, you are, so perhaps you can give me your thoughts.
It is a tough call, and ultimately, yes, we do need to normalize, and that is the right word, because technically speaking, we are actually marginally negative at the moment in a real basis, but the global scenario will dictate, and I agree, therefore, probably only next year. The global environment is going to be subdued for some time, and for that reason alone, you can postpone an interest rate hike.
So then that plays to your story on the dividend stocks, because effectively interest rates will stay lower for longer in South Africa.
Stay lower for longer.
In terms of the developed world and emerging markets, they're going to be hit equally by the negative sentiment, and throwing forward to that risk-off trade I was chatting to Neville about a moment ago. It's clearly in the system, and it's going to hit everything across the board by the same magnitude.
It can. Look, in this last recent sell-off, you've had a much bigger fall in emerging market stocks than you have in developed market stocks, possibly because developed market stocks are quite undervalued. Emerging market stocks, the debate is how big the discount should be relative to emerging markets, so maybe there's a bit more leeway for a fall. We can debate that or not. I'm not sure if it's justified, but I think in the risk-on, risk-off volatility, you will probably see bigger falls in the emerging market stocks, but that creates the buying opportunity. But as a whole, both of those asset classes are very, very attractively priced. It's the sentiment that's pushing the stock prices and not, in fact, the underlying fundamentals of those stocks.
When we talk about the developed markets, where specifically are the hotspots in your opinion? Perhaps let's just try and drill down into some geographies.
If you are very brave, the opportunities clearly are in Europe.
Not Spanish bond.
Not
Spanish banks, I mean.
Maybe not. And in fact, probably stay away from most banks within Europe. I think generally the sentiment there will remain negative for some time. But you have a lot of quality companies that are listed across the European economies that are not necessarily that reliant on European economic growth to actually generate excellent returns. But they are priced as lowly as a European company that is very reliant on European growth. And I think those are the pockets of opportunity, because in general, if you're European stock, you're just getting sold. No one's looking through to the true fundamentals of the opportunity. But it will be a volatile ride. It's not going to be easy.
And on that note, I'd be remiss if I didn't talk about Greece and what your opinion is of this situation that's unfolding. I know potentially it's anyone's guess at this time, and it's weighing on everybody, fund managers across the board. Perhaps sleepless nights are increasing right now. Do you think that we've got an imminent breakup of the Eurozone, or is that alarmist?
I think a partial breakup seems to be more and more acceptable, and also seems to be priced in to the market.
Do you believe it's priced into the market?
To a certain extent, yes, I do. And the last few weeks have probably priced it in a little bit more. I do think so, but it will be partial. But how it will be done and how it will pan out is anyone's guess.
Can it actually be orderly? Surely, if we're talking about a breakup, this is chaos, this is disorder, and I would say even if markets have priced it in to a certain extent, we'll probably see exactly the same reaction as we did when we saw the downgrade out of the US in terms of the rating. That everyone was saying it's priced into the market, it happened and everything tanked. Would that be a similar situation here?
It would be possible, and I think if you're in Greece, it's going to be pretty tough. But I think it will be quite short term, because a lot of this bad news is already priced in. If you look at the equity environment in particular, so much bad news is priced in. But it will add volatility, and it may fall a little bit more.
Are we better off here in South Africa?
By far. Our financial management in this country has been outstanding for decades, and I think we've benefited from that in our equity markets in particular.
Vanessa, besides the economic environment and the uncertainty out there, is there anything else that keeps you awake at the moment?
The volatility is the most frustrating of all, because what we're finding is that there are lots of opportunities out there in the marketplace, and the value is so compelling, and yet it's not being realized for investors in general in the equity space. You don't get a real return in cash, you don't get a real return in bonds, yet that's where the money's going. And eventually it will have to shift to true value, which I think is in the equity market. But I don't know how long we have to wait, and that's the frustration that's keeping you awake.
I don't want to get you to forecast, but just one more question I want to get in here. And again, it was a discussion point today at the Momentum Multi-Manager Conference that I was at, and that is the level of the rand. Again, it's very difficult to forecast the currency, we all know that. But an interesting scenario was put forward by Foot at Asset Management, Dwayne Schwauen, and he basically is saying that they believe that the rand is overvalued, and seriously overvalued, whereas they would see it trading or tracking. They've been calling it for 3 years, so it hasn't gone the right way for them, but rather close to 950. Not a forecast, but a scenario, a likely scenario.
If you look at purchasing power parity, which is the longer term trend that most of us could probably use with a reasonable amount of confidence, we're about there or thereabouts, so we're not that overvalued. Calling the currency is very hard, because the risk on, risk off kind of sentiment will constantly drive that currency, and we have the carry trade in our favor. So the rand can be 9 or 7 in a year's time, and that's a tough call for us, and we find that difficult to make. But on long-term purchasing power parity, the currency is about right.
Do you believe it's sensible, when we see this risk off trade, that we suddenly see flows heading for the hills, and by the hills I mean the US dollar? That's a safe haven?
I don't know if that's a safe haven, because what is the obvious currency to choose? It's not a dead certain answer. And in general, I think if I was managing a global portfolio, I'd be very diversified, because there's no obvious currency of choice. And probably with that would be a bit of a gold exposure as well. Be as widely diversified as you can in this environment, because there isn't a certain answer.